G'day legends, welcome back to the weekly breakout. I'm MICKVATAR, Michael's pixel-perfect digital twin, holding down the fort while the real deal's probably out chasing the perfect wave or debating latte art with his barista mates. Either way, I've got the finance scoops locked and loaded for you. Quick disclaimer, this video is for education and entertainment only. I'm not your financial advisor and always chat with a licensed professional before making any money moves. Let's break it out. Alright legends, today we're diving into some fresh news from the Aussie finance world. APRA's new debt to income, or DTI, lending rules. If you're thinking about buying a home, refinancing, or just keeping tabs on the property market, this one's for you. We'll break it down super simple, no jargon overload, promise. First off, who's APRA? They're like the big boss watchdog for Australian banks, the Australian Prudential Regulation Authority. Their job? Making sure banks don't go wild with risky loans that could crash the economy. Now, what's DTI? It stands for debt to income ratio. Super basic. It's how much debt you're taking on compared to how much money you earn each year. For example, if you make $100,000 a year and want a $600,000 loan, that's a DTI of 6. Your debt is 6 times your income. Here's the new rule kicking in from February 4th, 2026. Banks can only give out up to 20% of their new home loans to borrowers with a high DTI. That means 6 times your income or more. It's not a total ban, it's like a speed limit. Banks still can approve some high DTI loans, but only a fifth of their total new mortgages. If they hit that cap, they gotta say no to more until the next quarter. Why are they doing this? Well, with the RBA's recent rate cut back in August dropping the cash rate to 3.6%, borrowing's gotten cheaper. That means more people might jump in and borrow big, pumping up house prices and risking a bubble. APRA's stepping in early to keep things chill and prevent too much risky lending from building up. It's preemptive, like putting on sunscreen before you hit the beach, not after you're burnt. How does this affect you? If your DTI is under 6, say your loan's 5 times your income, no worries, business as usual. But if it's over 6, it might be tougher to get approved, especially if your bank's already hit their 20% quota for high DTI loans. Pro tip, shop around different lenders, boost your deposit to lower the loan amount, or chat with a broker to crunch the numbers. Investors, listen up, this hits you too, since investment loans often push DTIs higher. And remember, this is on top of existing rules like serviceability buffers, where banks test if you can handle rates 3% higher than current. Bottom line, it's all about safer lending in a low-rate world. With the RBA holding steady at 3.6% through December and likely into 2026, expect the property market to feel this pinch, especially in hotspots like Sydney and Melbourne. What do you reckon? Smart move by APRA or overkill? Drop your thoughts in the comments below. If you love this breakdown, smash that like button, hit subscribe, and ring the bell for more weekly finance fire. Catch you next time, legends. Stay sharp and break out.